Good morning, everybody. Welcome to the Flow Show, Tuesday, the 21st of May. Bit of a quiet start to the day, but still what's happening, so lots of trade. We'll get our teeth stuck into it anyway. Morning, Kay. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Yep, ready for what's to come. The week will start today, I guess, on the Canadian CPI.
What is to come? What is to come?
Well, perhaps today already the Canadian CPI, and then from then on it's going to accelerate.
Yeah. Let's put a positive attitude on things. We don't want to end up like Mark, do we? Otherwise, we'll be seeking counselling like he is. But let's go. Right. Finance Minister Suzuki, he says at this point he's concerned about the negative aspects of a weak yen, but has also said that a weak yen has both positives and negatives. So more a bit of shooting himself in the foot with those comments. Both him and Tueday will be heading over to Italy for the G7 shindig that's happening from tomorrow through the rest of the week. So finance ministers and central bankers all meeting up for that one. So we'll probably get a few headlines from those guys. Over at the RBA, we had the minutes out from their last meeting. It's pretty much chapter and verse for all the other meetings. They considered a rate hike, but judged the unchanged case to be stronger. That is almost word for word from the last lot of minutes. So nothing changing over there. They're going to still sit on their hands. Riksbank's Fieden says inflation prospects do look much brighter, but says inflation is by no means dead. Need to see substantial changes for a June rate cut, and a June rate cut is not on the table currently. That's been backed up by Riksbank Jensen saying a June cut not likely but can't be excluded. Those guys over there are looking for two more cuts in the second half of the year, so they got plenty of time to make that decision, but they're talking down expectations for June. Over at the Bank of England, Broadbent was speaking yesterday. He was out with a couple more comments. He said that the experience of the past 2 to 3 years has made MPC members wary about cutting rates. That wariness is going to be put to the big test tomorrow with the CPI, PPI data that's due to drop tomorrow. There's been some good news on the UK grocery front, inflation-wise. Kantar said that grocery inflation had fallen for the 15th month in a row, down to 2.4%, which is the lowest since October 2021. And also that was down from 3.2% in April. Now, this is data coming in sort of halfway through May, so it's not going to be affecting the CPI numbers tomorrow, although what happened in April will affect that. So it's dropped again in May, so that might be something that the BOE keep an eye on, expecting further falls in inflation on top of whatever we get tomorrow. Over in Germany, we had a bit of PPI data out this morning, coming in much softer than expected, down 3.3% year on year. The month-on-month number still showing a small positive, but not up as much as expected, 0.2% there. So positive month on month, but those year-on-year readings still coming in pretty negative. What we also got from the Eurozone, it just dropped not too long ago, was this labour cost index, which is not going to make good reading for the ECB. A lot of them looking at wages, ECB's Lane, for example, and costs in the jobs market or labour market coming in at 4.9% for the first quarter year on year, higher than the 3.4% previously. So that's something that they'll need to consider. Not that I reckon that will change anything with their expectations for the ECBK. But June's nailed on still, isn't it?
Oh yeah, I think so. They can always say that, oh yeah, but that was Q1. Now things are changing. So and it's also a number which I don't know. I mean, not that many people hang their hat on to that number, although it should be, and the market should be watching it because Lagarde told us to watch it. So yeah, I don't think it's going to change the June forecast for a cut. There's too many of them already kind of verbally agreed upon on it. So I don't see the June. It's all about what's coming afterwards, right? If July would be on the table or not, and I guess that's when is it? Tomorrow, Thursday, that we have CPI data out or PMI is out. PMIs.
Yeah, PMI is on Thursday. I think we get no, we had the final CPI, didn't we, for
Right?
April? Yeah. So it's the PMIs coming up this week.
Yeah. So
To,
I don't think it changes for June. But looks like the European bond market is questioning anything after June right now.
Yeah. So yeah, I mean that number there, that labour cost number, is probably something for the Hawks to lay at the doors of the Doves as to why a quick follow-up cut is not going to be their choice or the way they want to go. But yeah, that's still the open question, as it has been for quite a while now. What they do after June, we're nailed on for June. So just ahead of that, you've got to think that you don't want to be thinking about selling the euro if they confirm a June cut. It's all priced in terms of June. It's what we're going to be trading afterwards, after June, that's going to be the important trade. So that's just something to bear in mind going into that. Don't be getting short because you think the June cut will see the euro coming off significantly. It needs to be on other news.
If you're trading FX and you think euro would come off or so on a June cut, I mean, it's as Ryan says, it's completely priced in. You just have to look at the differentials where they are now. I can quickly show them a bit later because that's where really you expect, if you're trading euro dollar, you would expect those differentials to widen a bit if the market really wants to trade the cut, and the opposite since mid-April is actually happening. The differentials are narrowing.
Yeah, exactly. So yeah. Anyway, that's an early thought on how to trade ECB when we get into June. Right, it's a bit quiet on the data front. As we all know, yesterday there was NAFL out from the US. All we got was some Fed heads waffling on as normal. Fed's Bostic said the Fed is open to all possibilities and many economic scenarios. Thanks for that. Fed's Jefferson says the policy rate is in restrictive territory. He says that the better April inflation data was encouraging, but then says it's important not to focus on one data point. Fed's Daily says not yet confident inflation is coming down sustainably to the 2% target. There's no urgency to adjust interest rates. Fed's Mester says that the April CPI report was good news, but it's too soon to tell which path inflation is on. A rate cut depends on inflation progress, and the lack of progress was not welcome. Says Fed's policy is well positioned for risks on either side. They can cut rates if there is an unforeseen deterioration on the real side of the US economy. She's going to be changing her dots, it seems, because she previously saw 3 cuts coming, but now no longer believes 3 cuts is appropriate, but didn't elaborate on how many she sees now, whether it's 2 or 1. So it seems that's going to be the big risk for the next FOMC when they have their projections meeting to see what happens to those dots. But the market starting to think, and the Fed head starting to tell us that those dots are likely to be shifting up. It's going to be how high they shift up and how far out they shift up. So that's going to be the watch point. Okay, help me out, mate. That's it from the news front. There's really not a lot going on at the moment.
No, absolutely. There is very, very little going on. I mean, it's all about what's to come, right? Because we have on top of the Canadian CPI, UK CPI, we have the RBNZ coming up, and then there will be these G7 meetings in Italy, I think, right? They are. 23rd, 25th or so. Yellen is already in Germany, preparing the terrain, talking to a lot of people. There could be a few headlines coming out of there. So it's been an extremely quiet start of the week, and then for us traders, it gives us time to get ready for what's to come, right?
Yeah, absolutely.
So yeah. Right
Yeah,
now, there's very little going on, and we see it in the FX market as well. We still see the metals are on the move. Some of the emerging markets are on the move, but it's like as I said already end of last week as well. Markets are still trading relatively positive in the equities. Although we saw. But it's all like really small stuff. And I'm not talking about crypto, guys. Okay, I'm not going to go into this Ethereum stuff. But if you look at the markets, they're correcting just smalls, but everything is still looking a bit positive. So emerging markets are just enjoying enjoying life really. They're strengthening a little bit, but that is more having to do with the positive outlook or the positive trading that we have for now. Because if you look at the majors, sterling has been a bit strong of late, but today it's really everything is extremely quiet.
Yeah, but you're 100% right. You know, it may be quiet, but there's plenty of work to be done getting prepped for some of these events, and we can do that in a couple of pairs. Let's start with the CPI in Canada and what's expected. They're expecting their numbers to come down again. Headline CPI to come down to 2.7%, and then a dip in some of their other measures and core measures and whatnot. These numbers are all starting to come in with a two handle on it, so it's moving the right way. The BOC, they've not really gone out on a limb yet regarding timing of cuts. So I think you've got to look at what degree this CPI data moves. As I've said before, the pivot line for starting to move into a cut stance, shall we say, is getting below 3%. Now it's how quickly that might get down to 2%, which is the midpoint of the Bank of Canada's range. Their mandate is inflation at 2%, but they're happy to allow it to go in a 1 to 3% band. So I think if we get this number down close to or under 2.5%, that's likely to get the BOC talking up cuts from that point, I think, Kay. But if it comes on or around expected, maybe even unchanged, that's going to keep them sitting on their hands a bit, isn't it?
Sitting on their hands, yeah. But I'm also thinking that McClem is starting to lean towards give me a number that I can start to be dovish for real, and perhaps talk about a cut. They're all, those majors are all a bit barring of course Japan and Switzerland. Well, Switzerland is in that camp as well because they cut already. Barring Japan, they're all, I think, in the mood like give me numbers so I can start to cut, because they all also realize that now we have come to the timing where keeping rates higher for longer is okay, but they could start to have a bit of an effect in the second half of this year if they remain too high. So even if it's a symbolic cut, for some, they might just do one and then go on hold again. I think and McClem is no exception. I think he would love to see a lower number to at least do a sympathy cut, for the economy, continue to support the economy. So a low one could have a pretty decent impact on the Canadian dollar today.
Yeah, I think that's the same for all these central banks. The first cut is sort of popping the cork, really, isn't it? Get the ball rolling, and then once that's done, they're all going to sit back, take their time, and just adjust things as going. But until the market gets that first cut, this is when we're going to get all the jumping around. So, for dollar CAD, we're still stuck in this really, really tight range at the moment. Coming to the short term, you know, we're messing around still with this 136, 136.50. We've had a couple of little pokes above this 136.30, so that's washing out a bit. But really, you've got to be careful with this data as well. You know, if it is a big miss on CPI to the downside, then we're probably going to see this shooting up. But there's a reason it's down here, and one of those reasons is what's happening in the dollar. So, you know, I wouldn't be thinking, oh, okay, a soft number in Canada is going to see the loonie going all the way back up to 138 or something like that, or even keeping those gains. So, you know, we're talking about setting up for trading it. So if you're going to be trading something like the loonie, if there is a big data miss, then you've just got to look at, you know, the levels where we're going to probably run into trouble. As I say, we might bust this if numbers as expected or lower than expected, and we're up testing 137. Then you ask the question, okay, what's it going to do at 137? Is it going to keep going, or is it going to hold there? And if it holds there, what happens after? So, you know, again, as we say, do your homework, pick your levels. If you want to trade the loonie going into the CPI, pick your levels and let the data come out, and then decide what you want to do with the move. Do you want to fade it? Do you want to go with it? And let your levels be the guide for that. And either it does move or it doesn't move. Hopefully it moves, because then it'll give us something to do. But otherwise, and it's the same situation for all these pairs. You know, we're talking in our chat room about you know, what's happening, what's going to happen with the quid tomorrow over the CPI data. And I think you've got to take it in a bit of context. Everyone's expecting a big drop from 3.2 to 2.1%. That's a huge move in CPI. So you've got to look at two things. What if it only drops to 2.5%? Well, that's not what the market was expecting. It was expecting 2.1. So you might think, oh yeah, well, on that number we'll pile into pound longs and, you know, run it for 100 pips or whatever. But then look at the context. You know, if it comes in at 2.5, that's still 7 pips off the 3.2. That's still a big move. It's still inflation going the way the BOE wants it to go. And we've still got another inflation report to come before the BOE meeting. So, you know, does it mean that a 2.5 print rules out June? Probably not. But the market may still rally, or the pound may still rally on that number. Then that's why you've got to look at it in the context of the wider picture. Would that rally likely get hit once the market comes around to that realization that that's still a big drop in inflation, and that still puts us on course for a June cut? So take everything in context, okay? You can't just look at this one number and decide everything else for the next few months. You've just got to picture it in what it means right now and what it means for the bigger picture. And the same thing, pick your levels on the chart. We know that if we get up towards 128, that's probably going to be a sticky point. We're around 127 at the moment, so down 126.5, 126 is probably where we're probably going to run into trouble on the number the other side. So yeah, there's going to be plenty to trade, even if we're not trading it or anything right this minute, because it's a bit quiet. Euro sterling is another one I'm going to be watching for that UK CPI. Now, this one could be a bit dangerous depending on where we are. If we're still around this 85, 40, 50 area, I'm going to put some faith in this 85 zone, irrespective of what happens with the data. Obviously, if the data comes in higher than expected, then we're going to see the pound gain. We may get a test of this 85. If we're trading around 85, 10, 20, 30 going into the data, it's going to make this whole zone a bit, really, to put it bluntly, a fucking mess. Because, you know, if we do get strong numbers, we could blast through this 85 level, trigger load of stops, maybe run down, I don't know, 84.50, and then we see a strong bounce because, again, the market is taking it in context for what it means for the bigger picture, not what it means for tomorrow and 7 o'clock when that number drops. So, yeah, this one, if you're trading it again, just look at where we are going into the number. If we're up here in the middle, then you can probably trust that level or put a bit more faith in that level. If we're down close to it, then you've got to probably ignore it until the noise is over. Got any thoughts on either of those, Kay, the Canadian or the UK stuff tomorrow?
Yeah, I already said on the Canadian, I think Yeah, there are bids on 136 and below. We've seen a couple of tries to get under there, and it looks pretty big. So I think this 135.90 is going to be the level to watch. On the other side, I think some of those Canadian crosses are maybe interesting because Euro CAD is kind of holding. Sterling CAD is perhaps a bit dangerous because we need to wait for those UK data, right? But if you look at something where on a weak number, I think and you want to steer away from the dollar, I think Euro CAD may be an interesting one. If we get a sticky one, then I guess it's going to be dollar CAD the one, yeah, because we will be the US markets will be there already, and they probably will take the dollar CAD under 135.90 and then see where we end up. There is, I think I've got something. What's the lower end of your blue of your little zone there, just below? Yeah, that one.
Yeah, 35 and a half. Yeah.
Yeah, I think 5.5 is an interesting one as well. That's I think what I have as well. So yeah, so at least 135.5 if it's a real sticky one, because that will force McLem and the rest of the crew to yeah, to continue to hold really, and can't be more dovish, right? But I think they really hope for a low one, and if they get it, I think then the market will take dollar CAD or the Canadian dollar really a bit weaker. I think that for the Canadian stuff. UK, I'm actually still a bit surprised. We're expecting such a big drop. Of course, the core one is a bit less, 3.6 from 4.2, so that's 0.6 lower. But more than a percent lower on the headline is a big expectation. And then when you look at all the various expectations, some people are even expecting a one handle. I mean, I have a bit of a bit difficult to to view such a low number,
Yeah.
but taking the direction will be already of some importance. But if we get a big miss, that means much stickier than what they expect. Let's say that we are coming out like anywhere between 2.5 and 2.7. That won't be enough, I think, for the market to shift its view on the sterling and the way we trade it right now. I think if we get a sticky one, a real sticky one, this sterling is going to go for a walk because it's already bid, you know. And I'm thinking about cable. I'm a little long. I reduced it, of course, because of the upcoming data. But I have the impression that the market is perhaps gearing up towards a miss to the top side, so more sticky and perhaps going to trade sterling a bit stronger. So I'm also still a bit long in my sterling Swiss, but I've also reduced just a tiny bit this morning, just for the sake of getting the risk lower risk, and if we get a stickier number, I can always buy it back. So that's it. If we really get a weak one though, and that makes the whole thing pretty binary. If we really get a weak one, and even a match, you know, the 2.1, I think the market may put June right back onto the table, and for a possible Bank of England cut, and there in turn, people who are long sterling may run for the exit. So whatever happens in this number, I think anywhere between 2.2, 2.5 could be a bit of a up and down algo move, and then look at where we are going to be followers of the gilt market. But if you get like the extreme numbers, I think sterling is can really be quite a big mover, because as I've been saying already many times, this market tends to get a bit emotional when they see something where they can really stick their teeth in for trading sterling, right? On either side.
Yeah. I mean, I'm looking at the pairs. I'd be more inclined on a real soft number, you know, unless it's a one handle. Sorry, on a sticky number, sorry, higher number, I'll be more inclined to buy a dip in cable on in cable. Oh, I'm getting myself all twisted around. Yeah, a softer number that pushes a June cut will see cable coming off, and I'm more inclined to buy a dip in that pair than I would in any other pair, because as you say, Kate, it's been well bid. You know, we're really only trading the calendar, not whether they cut or don't at all. So I think the way the mood in cable at the moment is that dips will get hoovered up, and you know, we might get a significant one. You know, 126 maybe. That might look enticing for a few longs, as long as, you know, if it doesn't really break down. But even if we get down 124.50, I'll be looking to hit it there again. Anyway, I'm still along a little bit. But as I said, Euro Sterling is really the one that could be a bit messy. I'm still long. I would be interested in buying it still down at my 85, but not if we're that close. So I don't know what I'm going to do with my long. I might fold it all together and just pick up the pieces afterwards, or I just let it run and it does what it does, or I move my stop further down right out the way and then let it do its thing and take it from there. But yeah, I'm more keen on buying a dip in cable than I would be selling a rally in Euro Sterling. But we'll have to see. We'll have to see. Yeah, that's the point of trading.
Yeah, this Euro Sterling is a bit. It has come off relatively easily here. And where I thought for a while that this is just too big a level now to break, we will really have to wait for those data tomorrow, because it's hard to rule anything out at this stage, especially that the market has already in the back of its mind that ECB is going to cut. So if you get a real sticky one here, we may be in for a really thorough test again. Until last week, I was really thinking, like, if we ever see this 85.5 again, I'm just going to close my eyes and buy it, this Euro Sterling, and I'm actually doubting it a little bit right now. I don't think I'm going to put any orders in ahead of the release anyway.
You know what? This one has a habit of going close to that level when there's something coming up, like a BOE or an ECB or you know, big data. It has a habit of doing that, I've noticed, and it does. It makes it very difficult. You know, if we were trading 85.70, you know, I probably wouldn't care. Any move that took us down there, I'd hoover it up. But if we're down here, it's just going to be, I don't know. Yeah, it's going to be a little bit nerve-wracking to decide what to do with it. But that's trading. And we can always trade after the data once we see what
in any case, for all our listeners and viewers, just don't forget the timing of the release. 7 a.m. in the morning UK is still quite early. Some of the bond markets, well, we can all trade them on the futures and stuff, but they are not like officially open yet. So you could see like a liquidity issue as well, because the European markets are like right on the verge of the open when the release is happening. So do expect, if we get a number a bit away from the expectations, you have to expect some a bit more violent moves, whether it be just on because of the algos are reading the headlines. So I mean, be just a bit careful with whatever you have as a position in the sterling.
Yeah, and I will be crossing my own picket line in on my strike against 7 a.m. data, because I'll be around for it. Obviously, because I've got trades on, but also the kids are out early, so I'm going to be forced to be at my desk early. So yeah, we'll all be there. I'm sure you'll be there too, Kay, because it's going to be a big old one to watch, I think. Right, well, let's crack on. Just Aussie dollar, wanted to have a look at that. We've had 2 tests now of this support, and it's holding pretty well. I'll be a bit wary of a 3rd test. And you know my reasons why. The more times we come down and knock on a level, the greater the risk increases that it breaks. But at the moment, we're doing all right. We're just setting up this range. You know, we had this move into 67s, drop back to support, move back into 67s, drop back to support. We need to see what this rally does from here. Do we have another look up there? or do we just start making some lower highs, maybe, you know, just sub 67, and then that would indicate maybe we're going to get a little breakdown, because everyone's had enough of the highs up here, and anyone who's long in this area will be worried that we don't make new highs, and then we might see a little bit of capitulation if we see this 40-50 area break once more. But for now, it's doing what it needs to do. Gold as well. I was thinking about maybe having a little nibble long yesterday down towards that 24, but we didn't get that close. But this is, again, we're just seeing lower highs coming in and just nicking new lows. But this 24 level is obviously the big point here. We're holding it. So if you want to be looking for longs, that's where you want to be looking at. But I'll be pretty quick getting off if you see a rally, getting some of that profit in the bank, just in case we can't move back up to the highs. But for now, this is just showing a market that's had a break, and now it doesn't really know what it wants to do next. So just trust your levels. Either we go above this high or we go back below 2400. It was no different to what we were doing here. Are we going to go through 24, or are we not going to go through 24 or get back under 2360s? Well, the decision was the upside. So we know the range now, 24, 24, 50. Okay, I'm going to punch it over to you, mate.
All righty.
There's my buttons. There we go. And folks, while Kay's sharing his screen, if there's anything you want us to look at, just pop it in the chat there, and we shall certainly do our best to do so.
Okay, so I'm just showing those screens quickly, right? Because if you just to show what I was saying about the differential. So this is your short end differential, and we've seen from mid-April actually. So the higher it goes, that means tighter differentials between the Eurozone and the US. Okay, so the wider it goes, since the US interest rates are higher than the European ones, so the lower this goes, the wider that means, and usually is pretty supportive for the dollar if it goes down, and vice versa. Although of late those differentials have not really impacted much, but as you can see, even with the expectations of a June cut in the ECB, that's what I was saying. Like, if you want to trade those expectations, don't forget to look at those differentials, because that's what that is what the bond market is telling us, right? What they are looking at. And if you look at the 10-year as well, those differentials have been narrowing too. I didn't really put a lot of lines on there, but it's just sufficient to see what is going on. So expectations or a cut is not always like a guarantee for things to move. So if we in our FX market want to look at what the bond market is doing, just look at those differentials, and it may just help you make a decision. So for instance, if you're a seller of euro dollar, for instance, I mean you can, because we are holding below this 109 line, but your expectations are going to be a bit limited by this. Okay, so you always have to it can help you in your expectations. Of course, if we now start to see those green shoots getting destroyed again in the Eurozone, this is going to widen again, and then your euro dollar will likely come off too. But in the meantime, it's not just expectations that we are trading and they guarantee a move. No, the market has other stuff on its mind as well, you know. So and similar thing is happening in the sterling right now. So it's less. It also started a little bit later than in the euro, but it's also doing pretty much the same thing. And then let's talk about the expectations for the CPI. If the market really would think that yeah, this is something that I really want to trade, those differentials may be a bit wider, you know, and they are not, even though they're still negative, meaning that somewhere the expectations or the yields, at least in the dollar, are still a bit higher than those in the sterling. It has come off, but even coming off, you know, it doesn't necessarily mean that your cable is going to suffer. It did in the whole process, but right now, even with an expectation for a lower CPI, look at what the bond market is telling us, right? So, and you can look at, for instance, the gilts here, the 10-year gilts. They are actually they have come off a little, even though we already knew last Thursday what those expectations would be for today's CPI, and yet the gilt market is not yet trading it. So this market may just be waiting to trade the actual data, and then depending on what the market wants to do with it, that is going to impact then your cable as well, okay? Barring the levels, of course. And then let's look at those levels then. Now, first of all, on $CAD, yeah, this trend line is getting watered down now because, well, trading above, below. I really think it's 135.90. Oh, I actually have it a little lower. Well, okay, you have a level here around, yeah, 135.55. That's the lower end of Ryan's zone. But I would also keep 135.35 in mind, 35.40. Okay, that one, if the number would remain much stickier than expected. If it's a low one, I think we are going to get a test of 137 again. That looks to be the logic one. And then you look what's happening here. Anywhere between 135.90, 137.10, that's probably going to be your small intermediate decision zone. And if it would go, that means that we really have a low one, and Canadian is going to weaken. I'm keeping an eye on this one in this EuroCAD, because we are hanging around and even trading a little below above now, but we're hanging around this little zone that I've been mentioning already before, anywhere between 147.90 and 148.20. We're trading close to that. I think a low one. This could actually, if we get a low CPI reading, this could actually go trade a bit higher, perhaps up into the 149s. This is in the case of a low Canadian number. Yeah, a sticky one I would perhaps do $CAD. A low one I may watch this one rather. Yeah, we've been discussing this Euro Aussie in the room, and actually Leandro has also put out for those in our room, Leandro has put out a pattern in play as well, and I've just let it do its thing for a while, this Euro Aussie, but I still think that this 163 half 3/4 should cap the debates right now. So I'm putting it back on my radar to see what's happening. Also, Leandro, for those interested, is looking at a not the head and shoulder stuff, but he's looking at a pretty similar pattern and a pretty similar picture, and expecting this thing to cap around this level and then starting to go lower again. Therefore, though, we are going to need the stuff like copper and things to remain in positive territory, even gold and things like that. But I'm putting it back onto my radar, and but equally, as I've already said, we have to watch those low 162s, because that is now people looking at the other side. They are going to say like, yeah, but be careful because you have a triple bottom here. Correct. So 162.20-ish, 163 half 3/4, I say, on this Euro Aussie. All right. After the RBA minutes, hasn't done that much. The Aussie after the minutes, but they were still like relatively on the hawkish side, because they may be forced to stay higher for longer as well. So that may be the case, that if the market is really perhaps starting to trade the ECB, I don't know, this may have a look a little bit lower. Angela, good morning. Why just stick to dollar CAD? Well, I spoke about the dollar CAD, and we spoke about the dollar CAD, and also for people not wanting to have any dollar exposure, I've also spoken about euro CAD. You can look at different pairs, of course, but those are the two that we are going to be looking at for the Canadian CPI. Swiss pairs still pretty bit, I may need to go a little bit tighter than that one. Yeah, still hanging around the highs, the euro Swiss, but as I said, we still need to overcome 99.15 to continue this move higher. For the time being, this looks like we are in a corrective move, waiting for what's next. But for as long as we are now above 98 a quarter, 98 at 25.40, this still looks very constructive. Similar thing, and this one is going to be the interesting one. Yeah, I'll come back to that, Angela. This is now the interesting one ahead of tomorrow's UK CPI, right? I've reduced a little bit up to the top end of this box, and now I'm waiting with reduced risk, reduced positions to see what's happening. If we get a sticky one, this could fly through here. Same as in the cable, could fly through 127.5. This could go as well through 116, 15, 20, and then really go for another leg higher. So the reason why wouldn't trade a $1 exposure is that, I mean, some people are based in Europe. They like to trade crosses. I like to trade crosses, for instance, because I don't always have like a clear view on dollar exposure. If you because you don't only trade the dollar in this market. There is sometimes when, okay, now we are not specifically expecting large or big influential dollar data. So one could stick just to the dollar. But as I said, there's not only the dollars in the market. As you can see, I'm looking at a lot of stuff. I've always been a bit of a cross trader. I must admit, from my profession as well. When I was in banks, I'm been a yen market maker and dollar yen for a very long time. But before that I was trading EMS currencies. So I've got a long history with crosses myself and stuff like in those days sterling market, things like that. So I do like to trade a bit of a cross, and it's just a different way of looking at markets. You know, if you don't have an idea in anything dollar related, you may not want the exposure because you don't know what's going to happen next. You know, if we are on important levels, for instance. But we are not breaking them, or there is an uncertainty about breaking them. You may as well trade the cross. Like for instance, euro dollar hasn't gone too far from anything, but if you look then at stuff like euro Swiss, that has gone quite a move because the Swiss is on the move. You could have done dollar Swiss obviously, but if you look at crosses in the Swiss, you don't even need to worry about the dollar because of certain uncertainties that may happen. It's just another way of trading and another thing to look at in markets, you know.
I think it's also a question of opportunity as well, Kay,
Yeah.
because euro versus the CAD, a move there might put the euro out of kilter with what the ECB are doing. So you look at opportunities there. It's just about, yes, you can always look at the dollar, but there are opportunities elsewhere if things move out of sync with one side of a currency to another, and they're all playing the same game. All got this rate divergence going on. So yeah, I wouldn't say discount them. If you're happy sticking with the dollar, stick with the dollar. You know the dollar's going to overrule literally everything. But other crosses, there may be other influences that could impact as well.
Yeah, I like Angela's question there. Is it more suited to swing trading with the crosses? Okay, I mean, I know all retail traders do this and swing trade and stuff. I actually, for as long as I was in banks, we never used this term, to be honest. But yeah, let's talk about this. I think it's, for me at least, sometimes it's easier to stick to a position for longer. And for instance, most of the Mexican mix trades that I had on have been in the euro mix, because I feel a lot more at ease to keep positions for longer, and also for the reason that I'm looking at what yields are, and being short euro mix, for instance, and just for people who haven't been following us, I've been virtually, and people in our room can testify, but once the spike was over, I think I've been short Euromex from around here somewhere, in various episodes, but I've been really short Euromex for a very, very, very long time. But it's also the case that the dollar interest rates have gone much further than the euro interest rate. So for me, it's also paying better funding, better carry. But it also, to me, taking away the dollar, because sometimes the dollar moves pairs in the same directions as where, if you are in the cross, the different sensibilities about one and the other currency can come to their own right, as well, when there's not a lot going on in dollar pairs, you know. So for me, it's a case of the dollar may force me or out of positions, or may force me to take even take profits faster than I am in cross pairs, because they tend to perhaps move a little bit slower. So risk is, as we can say, risk is perhaps a little reduced versus dollar pairs, but it also in turn allows me to keep the positions for much longer. And that's why I really like to trade crosses. I have a lot of cross pairs in position. Actually, often more crosses than actually dollar pairs, as such. Right. So that a little as to why. Very good question, by the way, Angela. I like that. Well, since we're on it, Euromex, I know it's a bit of a in-between trend line here, okay? But there's enough levels that have been traded, enough points that have been traded and holding it. We're trading a little below 18 now, okay? I have scaled back a little bit, just ahead of this this next support line. But depending on if it goes, I may actually push the position a little bit again and increase it. So it's still looking heavy. And as I don't know if Ryan already showed the dollar mix, but to me, the dollar mix is now entering a bit of a zone here, anywhere between 54. This is the weekly. Yeah, even so, even on this one, because I just want to remind people that when we went below 1650 the other time, Lopez Obrador, the Labrador, even the president of Mexico started to talk about Mex being a bit strong. So keep an eye on if ever we would go towards those prior lows again. This is now a very important zone on the longer term. I think we are entering here. We have seen those major zones resist or support a bit in the past as well. But I would really start to pay attention now to what's happening, especially if we start to dive under 1650 here. I know Ryan has a position, good position as well. But on the other hand, for as long as, for me at least, we are below this 1678.82, it's still very much looking to the downside for me. That's the nature of the beast is still telling me that that is looking very heavy. It's looking very heavy still. All right, I think, yeah. Yeah, Ryan, you were talking?
Yes. No. I was just flicking my mic on. Yeah, I wasn't sure if you were done. Are we gonna,
Oh, yeah. Go ahead, mate. I am done.
Yeah.
Did I talk about silver? I just went over it, and then we spoke about something else. Yeah, so we're still above this 30.5 for as long as we are above. No change, but please beware of the big swings, right? We've been up to 32.5 and all the way down to 31, okay, today. So that's a pretty hefty what is it, 5% move, right? So like, be careful with those moves whenever you are in a position. But for the time being, I would say it's still oriented to the top side. I'd start to be worried with late longs if we get back below this 30, 50, 60. Okay, so that's and I would expect some form of resistance, perhaps around 33, before we can talk about the bigger picture around 35. Okay, back over to you, Ryan.
Thank you very much, mate. All good news. The IMF have raised UK growth forecast for this year to 0.7% from 0.5%. Oh, well done, those guys. Another lot absolutely useless with their forecasting. Exactly. They assume a half-point rate cut from the BOE this year. Absolutely clueless, them lot. International Monetary Fools is what the IMF stands for. Anyway, we shall call it a day before I really start ranting. Thank you, everybody, for coming to the Flow Show. As always, if you're around for the UK data tomorrow, we'll be on point to guide you through that. And obviously later on for the Canadian CPI. Thanks, Kate. As always, have a brilliant day, everybody. See you all tomorrow.
Cheers, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.